You know, what concerns me at the moment is that trade, instead of being that sort of big window of opportunities for those economies that want to compete with each other, it weighs like a big dark cloud on the global economy. And based on the latest calculation of the IMF, if the tariffs that are either here already or threatened to be applied were to apply, we're talking about reducing global growth by 0.8%. That's a massive number.
That was former IMF director and incoming ECB president Christine Lagarde talking to our own Sarah Eisen this weekend about trade. You can hear the full conversation later today on Squawk on the Street and The Closing Bell. Joining us now to talk more about the markets in the week ahead, Michelle McKinnon, Senior Wealth Advisor at Payne Capital Management, and Jay Jacobs, Head of Research and Strategy at Global X Funds. Guys, good to see you both. Jay, I'll start off with you. Where are we in the markets? I mean, not yesterday, Friday. We certainly were a little volatile based on these headlines that the Chinese had canceled this trip to visit farms in Montana. I mean, we seem to be very, very fragile according to what trade headlines cross.
Yeah, and I think that's because there's a lack of other things happening in the markets right now. We haven't really ended up in like a full-blown earnings cycle yet. There isn't a ton of other information coming out, so people are really grabbing onto data and headlines that they can. That's why I think the PMI headlines out of Europe today are actually going to play a very big impact on the markets, because that's hard data showing that global growth is, in fact, slowing. Mm-hmm.
We got manufacturing out of Europe, manufacturing out of the United States as well, Michelle. So what should we be watching for in the coming weeks, since we are in this sort of vacuum ahead of third quarter earnings?
Yeah, I definitely agree with Jay that there's not a lot to kind of stir the markets. However, I think when you think about the sell-off that we had on Friday, which was 100 points, 150 points, that's not that large compared to a few months ago or even a year ago when we would have gotten a trade headline and the market would have moved 400 points. So I think the markets understand that until we get an actual ceasefire or deal, that we're not going to really move much. And in all honesty, when I look at all the different factors, I really think markets are poised to go higher here. And if you do get some type of ceasefire or a back down or even just a partial deal, markets are absolutely going to explode to the upside.
So moving higher is predicated primarily on trade, on some sort of breakthrough, some sort of positive development?
I think some sort of breakthrough, but also I think earnings. You know, obviously earnings don't look great coming into this quarter. However, just like last quarter where we are expecting a negative earnings season, we actually had a slightly positive season. So I wouldn't be surprised if we do get another slightly positive season, which could push markets further here.
Mm-hmm. The timing of everything is very interesting because we have the higher level trade talks happening right now. October 10th is what's scheduled. And then third quarter earnings season should probably kick off at around the same time or a week later. So what do you expect? I mean, it seems like we're primed for a very rough sort of October, middle of October.
I think that's probably true. I think the bigger mover in the markets, though, is going to be the Fed and what happens in December and just general kind of discussions around the global central banks about how much easing they're going to do to support this market. I mean, what we've seen over and over again is that the trade war discussions have led to nothing, but the Fed has been the biggest driver of stocks.
Isn't that, though, going to be driven by what happens with third quarter earnings season? That's what we saw a year ago, right?
Yes.
I mean, when the Fed started to change its mindset, it seemed like precipitated by what companies were saying in third quarter guidance.
I think that's definitely true. And if you look at third quarter guidance, we're expecting negative earnings again for the third quarter in a row. And yet, if you look at 2020, they're expecting 10% earnings growth. So it's actually a very pivotal quarter to see, are we on an upward trajectory into 2020 or are we continuing a downward trajectory into a lower guidance period again?
What sectors do you like, since you think the markets are going to go higher? What will work?
Yeah, I mean, I think, obviously, without question, there's a lot of negative headlines. So I think markets are going to go higher, and particularly when you think about the alternative, right? Bonds. I mean, bonds, the 10-year is sub 1.7. You've got earning yields on the S&P of 4.5. It's like, how can you not be in the market? I like value, just like probably a lot of investors sit here and say that. I particularly like healthcare. Again, you've had a lot of negative headlines, right, with the political election coming up and obviously very serious headlines with the opioid crisis. However, healthcare isn't going anywhere. You've got 73 million baby boomers in this country. They're only getting older. And by 2027, the U.S. government is estimated to spend $6 trillion on healthcare expenses. So I think you can have confidence going into the healthcare sector even with these negative headlines.
You could have made the argument about stocks and bonds 5 months ago.
Absolutely.
6 months ago, 7 months ago, 8 months ago. So what changes? I mean, is the bond rally over?
I mean, good question. I certainly think that the bond rally could be over. However, I certainly don't think you're going to see 4% yields anytime soon because we're in such low inflation here.
Mm-hmm. Do you agree that it's time to move away from bonds, or that it's not, that equities should take first place over bonds?
I agree. If you look after taxes and after inflation, the real return on the Barclays Agg right now is negative. So investors that are in bonds are actually losing value.
For what time period?
Currently, if you look at the current yield and you back out income taxes and actual inflation numbers. So investors have to be in stocks to see a positive return right now. I think that's going to continue.
But year to date, let's be clear, year to date, if you were to invest in bonds, you've done quite well.
Year to date of performance, but if you look at the current yield on the Barclays Agg, and you take away taxes and inflation, that actually puts you in about negative 20 basis points territory. That's what people are looking at going forward.
And that compares to what on the S&P 500 then?
Well, the earnings yield on the S&P 500 is just shy of 6%. So if you take
one over taxes
PE,
and all that stuff, what's apples to apples?
That's still positive because it's taxed better. We're looking at better valuations.
All right, we're going to leave it there, guys. Thanks, Jay and Michelle. Appreciate it.